Looking for a place to invest your cash? Vanguard says there's a new option. I've had this email a bunch from you guys, so I figured let's go into this. If you're saving for a short-term goal like a vacation or buying a car, you probably want an investment that has relatively low risk and can earn a return as well. For money you'll need in 6 to 18 months, consider our new actively managed ETF. We're going to launch it in the spring, the Vanguard Ultra Short Bond ETF. Taps in the experience of our fixed income managers for an ultra short strategy that bridges the investment gap between money market funds and short-term bond funds. Higher potential yields than money market products. They generally, because ultra short-term bonds generally tend to offer a higher yield than money market funds, bank products, and CDs. And they have fluctuating share prices. That's weird. They say it has a higher yield generally and has fluctuating share prices. You would thought they say, but they have fluctuating share prices. Interesting. However, they shouldn't be viewed as a substitute for retail money market funds, which historically remain a stable value of $1 per share. Well, they just say they should be. Oh, good day. They say, didn't we say? Yeah, they're trying to be the gap between money market funds and short-term bond funds. Less volatility than short-term products. The ultra short-term bond ETF is expected to have a lower volatility than short-term bond products, which tend to be more sensitive to interest rate changes because of longer-term debt. Expense ratio is about 10 basis points. And invest in a diversified portfolio of high quality and to a lesser extent medium quality fixed income securities. Okay, so then we clicked on the Vanguard thing, and I wanted to see if we have anything on like some of the holdings they have. We got Caitlin Coughlin. Will features the ETF structure of investors seeking a solution for anticipated cash needs in the range of 6 to 18 months. Let's see. It'll be managed by Samuel Martinez. Blah blah blah. All right, but it doesn't really say anything about the actual product itself. Okay, so let's look. I wanted to look at some history of ultra short-term funds, bond funds. Let me give you an example. When I was back in my broker days, there was a Hartford floating rate fund that came down the pike, and that was everyone was using that as an offset to cash because it gave better yields as bank loans, which were pretty risky, it turns out. And it just trust me, man. We said, oh, this is pretty good. It never had a down year. I think it was around for 15 years. It never had a down year previously. And then 2008 came in and boom, we got smoked. So I'm very cautious. So let's check out the Hartford one. Bear with me just a second. It's a Hartford floating rate fund. I'll never forget. So basically, Hartford introduced this floating rate fund right here in 2007, maybe latter part 2006, I can't remember. But floating rate funds had been around for 15 years previously and never had a down year. And that was a sales pitch, which I bought into. And the guy who sold it to me to sell it to my clients, he didn't know any better because we didn't know what was going to happen in 2008. And then it was down 30% in 2008. So it seeks to provide a high current income and long-term total return. High current income and long-term total return. Normally invest 80% of his assets in below investment grade variable or floating rate loans and floating rate securities selected by Wellington. Wellington owned it, so I ran it. So I was very keen because I love Wellington. The fund may invest up to 20% in net, 25% net assets of loans to foreign borrowers and securities, all that. But if you went and you looked at the duration, this is what with it. I'm sure they got duration on here someplace. Hold on a second. Oh, it's gonna be risk probably. Let's just look here. I remember I said, oh, the duration is low, so there's not much risk. I don't see duration there. Risk. Let's see if it's on here. I can't remember where it's at. Why wouldn't they have duration right under risk, man? It's freaking stupid. Come on. Ours for a bond fund, there should be. Let's look at holdings. Maybe it's under holdings. Yeah, duration right there. All right, so basically, remember, duration means for every 1% increase in interest rates, that's the downside risk of the portfolio. So this having a less than 1 year duration, with in this case, maturity to 4.57, you're thinking, oh man, there's not much risk, interest rate sensitivity. Well, it turns out that there's a whole lot more risk than that because when there is no liquidity in the bond market for especially junk bonds, it was ugly. All the words to it. So my first concern about these things is what happens, what kind of risk we're taking on. So let's look at one of these older ones that date back, and we'll just look at. Let's see. We're gonna go back to here. We'll look at. All right, FGUSX. That Federated Hermes, FGUSX. Oh, Western Asset, ARMZX, ARMZX. Western Asset's a good bond fund. So ARM, ZX. Yeah, right here. So let's see what this did. Western Asset is well known to run as running fixed incomes. They got good fixed income shops. So let's see what, I have no idea. Let's see what this did back in those days. We'll go to performance. See if they got smoked. Yeah, 5-star rating. So in 2000, yeah, see that, man, look at that. That was down 17% as well. In 2000, see now 2000, 2001 and 2 is up, but look at that. See, and then you're not having short-term funds that could be down 17%. That's not good, man. All right, that's Western Assets. Let's look at full BIX. Full BIX. FULBX. Full BIX. Federated Hermes. You know, like Hermie from Rudolph, isn't that his name? Hermie. Let's go to performance. Is it performance? Yeah, I think so. Yeah, that was down 4, so that's not bad. 4% in 2008. Still, I mean, if it's down 4%, you just sacrifice all your gains, man. All right, so let's go to one in here's Calvert. They think they're all that in a bag of chips because they're socially responsible. QLAX. So and they love to tell you how socially responsible they are. So let's see what this guy did. Oops, gotta go performance. All right, so that one was actually up 3%. Well, good on Calvert. All right, so let's see here. Let's look at let's look GEIAX. 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 Goldman Sachs. Enhanced income. Ugh, I bet that got smoked. Let's take a look at performance. All right. Oops, what happened? Ah, man. Up an extension. Okay. So let's go back. And then go to performance. Yeah, look, that guy was down 15, 16, 11. No, 2008 is actually up, so good on them. But still, I mean, that's the point though. You're not getting any yield. I mean, you're getting such a low yield now. You don't want to risk it by having a couple bad years. It just doesn't make sense. Ooh, PIMCO, PSHAX. That'll be the last one. Look at PSHAX, PSAAX. All right. So the question is, what's the point? I mean, you're going to get. So we'll see. Bear with me just 1 second here. And this guy, PIMCO. Again, another firm known for its fixed income shop. In 2008, it was down 1.65. All right, so now, actually, does it show us what will this show us what the current yield is on this guy? 1.52. All right, so I mean, if that's PIMCO, let's look at some ETFs here real quick. All right, let's go back here. We're gonna fund category taxable bonds. Let's see if we got any ETFs. Let's see. So hold on just a second here. It's weird because the Vanguard actually has an ultra short. What is this? Ultra short, some kind of ultra short mutual fund. Yeah, Vanguard short term bond investor shares, VUBX. Yeah, so the yield on this guy is 0.49. So remember, you don't pay much. So the distribution yield is what happened in the trailing 12 months, the last 30 days of the SEC yield. So you're getting 0.49%. That's on the bond fund. I mean, it paid over 12 months 1.52, but you just got to look at the 30-day SEC yield by and large. Anyway, be it as it may, the issue that comes to mind is, all right, what are you getting in return for, we'll even say 1% yield? Well, you're getting more risk, man. I mean, that's just a fact. What does it tell us? I'm sure Schwab will tell us duration here. Inverse fund. So they're going to have 862 holdings. Good. Yeah, I'm not sure what the duration is. Anyway, it's probably not going to be much if rates go up. Man, where is the risk? Probably holdings. Let's take a look at our holdings. Okay, that's the holdings. The holding statistics. Okay, so that just it was on risk. Is that where I just was at? Let's see. Risk and total returns, fees, cost ratio, sharp, beta, upside capture. Wow, man, why do they make the duration so hard to find? Summer distributions, holdings, fund facts, and fees. Let's look at portfolio. Was that where it's just at? Long, short, country, long, short, fixed income, credit ratings, maturity breakdown. Yeah, duration right here. So 0.91 is the duration. Effective maturity 1.3 years. I think you're getting not enough return for the risk that you're taking, if that makes sense. And we just saw some of the risk that was out there from previous years of ultra short-term bond funds in 2008. Some got hammered, some did okay, they made money, but if you're only increasing your yield by 0.5%, so think about it. 0.5%. We'll just say $50,000. What's that? $250? Yeah, you're making $250 extra for a little bit of risk that you could easily lose that $250 plus more. Yeah, I don't think it's worth it. All right, like to hear your thoughts. We'll see you.